I'm sure a lot of you have heard recently in the news, at least, about the implosion of the crypto exchange FTX. And as I read about it more and more, I realized there are a lot of interesting similarities between this whole event and the financial crisis back in 2008. So I wanted to discuss some of the interesting similarities and also some of the possible lessons we can take away from both of these events in financial history. So to get started, I want to preface this by saying that traditionally, when we think of bank failures, we think of these bank runs, where these large hordes of people are crowding up at banks and trying to get their money back from the bank. And more often than not, the bank simply doesn't have the cash on hand to return all of the money to the people waiting in line. And we see this all the time in media, like in movies such as It's a Wonderful Life from 1946. Now, in modern finance, bank runs like this are very rare, almost impossible, because of a whole host of reasons. But what's interesting is that bank runs as a concept are still possible. It's just not in these retail deposit markets. It happened in different ways, both in 2008 and in the crypto implosion. So I think it's interesting to look at each of those from the perspective of a bank run. So starting off with the financial crisis, if any of you have watched a movie like The Big Short, or if you've read the book Too Big to Fail, I'm sure you've already heard a lot about this, but I'll just summarize it quickly to explain what exactly were the precursors that led to the collapse of the financial system. So our traditional view of banks is always that they take cash deposits from depositors and then use it to issue loans for mortgages, auto loans, student loans. It could be anything like that. But for a long time, and especially in the early 2000s, investment banks had a very different approach to loans. They would actually buy mortgages from mortgage originators, and then they would package these mortgages into very complicated securities. And they would sell these securities off to investors like pension funds, mutual funds, or other large financial institutions. And the whole point of this was that instead of making money by directly issuing the mortgages or the loans, they would serve as an intermediator. They would buy mortgages, package them up, and then sell them off to investors for a profit. Now, you can imagine that from an investment bank's perspective, it's very beneficial if they can borrow a lot of money to buy more mortgages, to then therefore package more of these securities and then sell them off for a greater profit. So the key link I want to emphasize there is that being able to borrow money freely and quickly was important for these banks in making a profit in this securitization business. And the way they borrowed money was through something called a repurchase agreement or a repo agreement. And this is a very important tool that ultimately led to a lot of cracks in the system for 2008. So I'll explain this using a diagram. Let's say Bank A is our investment bank, and it wants to borrow some money from Bank B. And this is happening on Monday. So repo agreements are an overnight agreement, which is why I'm listing the day that it's happening here. On Bank A, on Monday, Bank A will say that I have, let's say, $100 worth of some security, right? It's some collateral that I can post for my loan. So Bank A will tell Bank B that I will pledge all of this collateral to you. And in exchange, Bank B might say, okay, that's great. I'll take the $100 you have, and it's in return, I'll give you $98 of cash. And it's going to optimize that spread between 198 based on the risk it perceives of Bank A as someone who's borrowing money. Now on Tuesday, Bank A is going to have to buy the security back from Bank B, and it'll just send the cash back that it borrowed originally to complete this transaction. Now, the important thing here is ignoring all of the intricacies of this agreement, this is effectively saying that Bank A can borrow $98 for every $100 of securities that it owns. And this is referred to as a 2% haircut on the collateral that Bank A owns. Now, this is just with two banks, but like I said, it was important for investment banks to be able to borrow lots and lots of money for every one of these transactions. And so the problem with the system is that they really leveraged up these loans across multiple banks. So the way it would work is, let's say Bank A borrowed $98 in cash from Bank B. It would then use the $98 to buy $98 more of collateral, and then it would pledge this to Bank C in exchange for, let's say, $96 in cash. And then again, repeating the cycle, it would buy $96 of securities, pledge this as collateral for Bank D, and then Bank D would give it $94 in cash. And you can imagine how this might go on and on and on. In fact, there's actually a mathematical limit to this where for a 2% haircut, the total leverage in your system can be 50 to 1. So what this means is for an initial collateral amount of $100, this bank A could borrow up to $5,000 worth of assets. And just to give you a perspective on just how large this system was, the total repo market in 2007 was nearly $10 trillion across all investment banks and their counterparties, meaning the people lending to them across different types of institutions. So it was a huge market with a lot of risk involved in it. Now, one thing I haven't mentioned so far, which is kind of a key assumption in this, is that all of these banks have to think that the securities Bank A is pledging as collateral are actually worth something, and that they're good collateral. If they start to doubt the value of those securities, then those banks will start to demand a higher haircut percentage from Bank A. So instead of $98 in cash, Bank B might say, I'm not so sure about the value of that security you're pledging. In exchange for $100 of that security, I'm only going to give you $75 of cash in return. And so this is really what ignited the collapse of the financial system, because a lot of these securities that the banks were pledging were mortgage-backed securities. And as investors lost confidence in mortgages, this started a cycle of deleveraging across these banks. So I've created a little diagram to show how this led to a broader financial panic across the system. So initially we have subprime mortgages starting to fail as homeowners are defaulting on these loans. This then led a lot of investors to lose confidence in banks that had exposure to these mortgage-backed securities, like I was mentioning earlier. This then caused lenders to demand higher haircuts on these repurchase agreements that were backed by these securities. Now, when lenders are demanding higher haircuts, this means that the banks are going to have to start selling some of the collateral they initially posted to pay back those lenders. So what they did is they just started rapidly deleveraging and selling off these securities. But the problem with this is it only accelerates the whole cycle. As banks start to sell more of the securities, the value of those securities starts to decline at an even faster rate. And then what happens now is investors see that, and then lenders panic because they think that the value of these securities represents the confidence of the whole market in these mortgages. So if the confidence is going down, they demand even higher haircuts, which again leads the banks to deleverage. And this goes on and on and on until we see some bankruptcies essentially with these banks like Lehman Brothers. But the problem was that this panic spread to all kinds of different credit across the financial market. So not just with mortgage-backed securities, but even corporate bonds or securities backed by like student loans or even credit card debt. So I've laid out this whole cycle, and now I'll compare it to the way FTX dissolved in the last few weeks. FTX at its very basic premise is just a cryptocurrency exchange. It serves as an intermediary between people who have normal financial assets like US dollars and people who have crypto assets like Bitcoin. So normally FTX might say, if you want to exchange your dollars for Bitcoin, I can do that for you. And at the same time, if someone else has Bitcoins, they want to exchange for dollars, it can also intermediate that exchange. But FTX made it slightly more complicated when they involved this third-party firm that Sam Bankman-Fried also owned called Alameda Research. And Alameda Research was actually a trading firm, not an exchange. So they would make very highly leveraged, risky trades using the money that they had. And the problem with FTX is that FTX would loan them the deposits it had of dollars or Bitcoin. And in exchange for that, FTX would demand collateral from Alameda in the form of these tokens called FTT tokens. Now, what's interesting about FTT tokens is that these tokens are essentially linked to the public's confidence in FTX's financial stability. So if people think FTX is going to fail, the value of this collateral declines in the same way that the value of that mortgage-backed security collateral declined when investors lost confidence in subprime homeowners. So the real weak link of this chain was that the collateral FTX was using to back all of these loans it was giving was directly tied to the perception of its stability. And so if we look at the same chain, it's actually a very similar sequence of events where initially everyone thought that, so just going back to this diagram, everyone thought that FTX had actually loaned out too much of its customers' deposits. So they initially started panicking, thinking that the deposits they initially put into the bank were no longer there because they had been loaned out. And so that initial loss of confidence started to cause investors to start to withdraw money from FTX. This then started a loss of confidence more broadly, which led to FTT's token price declining. Now, in order for FTX to return the money to its depositors, it needed to sell the FTT token in order to exchange it for dollars or Bitcoin. But again, as it sells these tokens, the price declines even more, which then leads to a broader panic, and then it just cycles all over again. There's actually a term for this, which is called wrong way risk, where the collateral itself is correlated with perceptions of the company's stability itself. And it really leaves the company at risk for this kind of vicious cycle. So with all this being said, what's the big lesson with this comparison between the two? I think that there's an inherent financial innovation cycle, as I like to call it, that happens in all of these markets. And it's a bit of a skeptical or cynical viewpoint, but it sort of explains why, regardless of how advanced financial markets are, regardless of whether it's traditional or in cryptocurrency, we sort of see the same cycle, where in good economic times, you have some financial innovation, like securitization in 2008 or tokenization with the modern crypto world. But because this financial instrument leads to high amounts of leverage in the system, it eventually leads to a peak after which you have some cracks that are exposed in the system because of too high amounts of leverage or just dubious values in a lot of these assets. And then it leads to the slow deleveraging cycle where eventually you have a bubble that bursts, and this leads to a broader financial panic. So the interesting thing and the kind of funny thing about this whole incident is that crypto is essentially just relearning the lessons that the rest of the financial world learned back in 2008. And it's interesting to see them fail in the same way that we saw firms fail back then, even though we've had a lot of learning being done since then. So going forward, I think it's interesting to see how the regulation will change in crypto, and if we'll see any more of these sorts of broad financial panics happen the same way that they did in 2008.